Our final speaker for this morning is Brian Selmo. Brian is a portfolio manager at First Pacific Advisors. FPA managed the Nedgroup Investments Global Flexible Fund for us. Brian, welcome. Thanks so much for joining us.
Thanks for having me.
Great. So, Brian, I guess let's just kick off with performance then, where the fund has done very well recently. And if you can please take us through the numbers.
Yeah, if we look at this slide, you can see that the fund has gained 4.9% in the third quarter and 13.3% year to date. And from our perspective, more relevantly, has outperformed the performance indicator in all the periods shown, which go a little bit longer, back to 5 years. That's kind of consistent with our goal and indicative of the underlying exposures in the portfolio outperforming the relevant indexes.
Thanks, Brian. And which specific holdings would you say had the most notable impact on the portfolio over the past year? I mean, anything you wish to highlight in particular?
Sure. Here you can see the companies, the top five and top and bottom five in terms of contributors and detractors. The top five contributed 6.4% to performance, and the top five detractors detracted 2.6%. The only real event of note that happened in any of these companies is that JD Peets was agreed to be acquired earlier in this year, and that drove strong performance in their shares. Otherwise, there's no particular event or activity that we would call out that we think drives the performance here.
Yeah, and from an asset allocation perspective, how has the portfolio changed over the past year, please? I mean, anything interesting that you want to share about that?
Yeah, if I look at this page, you can see a few things. One, the aggregate exposures have not changed very much over the last year. So cash has come up about 1%, but otherwise the exposures remain pretty similar to a year ago. But despite the sort of lack of apparent activity on the surface, the duck has been paddling fairly rapidly from our perspective under the surface, and that can be seen in the number of names that have increased in the portfolio. So you can see there are 10 on a net basis. There are 10 new names in the portfolio over the last year, and that represents 15 new purchases and 5 sales. And so we have an average holding period of 5 years, and so that represents an above average level of activity in our portfolio.
Good point. Thank you. And Brian, tell me, is there a particular region or sector that stands out for you in the way that you have constructed the portfolio?
Not currently. If we look at page 5 or slide 5, you can see that the fund is broadly diversified by geography and by sector. So there's not any one particular sector theme that we are seeing right now.
I think that whole theme of diversification is important because the portfolio does seem to be very well diversified. And tell me, how should investors view the geographic composition of the fund, please?
Yeah, there's two ways that we look at this. One is by where companies are domiciled. Roughly 60% of the businesses are domiciled in the US, the rest are globally. But probably more importantly, from our perspective, over 50% of the revenues or the business activities are global or outside of North America. And so, from a geographic perspective, as well as by industry and sector, as we mentioned earlier, we consider the fund to be very diversified.
Thanks, Brian. Perhaps changing tack a little bit now and focusing on some of the more interesting areas of the market and opportunities that you are seeing. Like, which areas would you say are offering attractive valuation opportunities, or potentially contrarian or overlooked areas of the market that you're finding?
Yeah, sure. And I think, as I mentioned earlier, there has been a fair amount of activity in the portfolio over the last year, and that activity has really been what I would call off the beaten path. And so I want to unpack that a little bit by looking at the composition of the market and what looks expensive and not, and then talking a little bit about what we've been buying. And so this first slide shows you the multiples for the US market in the red line, and then the ACWI in the blue line, so the world averages. And you can see that, with the exception of the dot-com bubble in the late 90s and early 2000s, the markets are roughly as expensive as they have ever been in the last 30 years. Now, that's, again, at the surface. If we peel this one layer and look at the next slide, slide 8, you can see that the top 10 companies, so the 10 largest businesses, make up a larger share of the index today than they ever have in the past. Now, these are very high quality businesses, and relative to their earnings, they trade at premiums to the overall market. That point is underpinned further on page 9, which shows that the 10 largest companies are trading at, roughly the largest multiple that they've traded at, again, with the exception of the dot-com era in the late 90s, early 2000s. And that's well above their historic averages and well above the market averages. So that shows a very concentrated market from that perspective that is, fairly fully priced from a historic perspective. The next slide takes another look at that, and this is the portion of the S&P 500 that is trading at 10 or more times revenue, which is a rough proxy for, very expensive businesses. I think there's a famous quote from Scott McNeely when he was running Sun Microsystems in the late 90s, and that business traded at 10 times earnings. And he said, "Hey, I don't think you really understand what you have to believe to think I can make you money from 10 times revenue. I can't pay any employees. I can't pay any taxes. I can't pay any suppliers. I don't know that I can get away with doing that, and it'll still take me 10 years to get your money back." That's a pretty aggressive set of assumptions you have to make. And here you can see that in terms of the overall market, never has a larger portion of the market been trading at that kind of multiple than today. Now, the next slide we'll talk about is probably a bit of the why, and slide 11. And this is a JP Morgan slide that is depicting what they view as the AI-driven businesses and what they make up as a portion of the market. Now, this only goes back to the time when ChatGPT came out, but this is kind of the last bit to the stool of what's going on kind of at the index level. And that is that, things that are beneficiaries and or perceived to be beneficiaries of AI or the build out are, obviously doing very, very well, probably have a lot of runway for them, and, make up a large portion of the market cap. And so that's a picture of a fairly concentrated, index, a fairly exposed to a narrow, theme or idea, and a fairly expensive index. And so I think that that's what everyone sees on the surface level when you say, how's the market doing, or what's going on with this performance indicator or that. But then if you look a little bit below, and this will be now page 12, this pulls apart large caps in the red line from mid and small cap companies in the blue and green line. And you can see that the small and mid cap companies are trading at about as wide a valuation discount. Perhaps it is the widest, from my eye at least, to the large cap companies as has been in the last 30 years. And so I suppose unsurprisingly now at the end of that, where we've been spending really most of our time analytically, and certainly the new names that have gone into the portfolio over the last year have been, mid and small cap businesses. In the last, 6 months, we've actually been purchasing a number of healthcare or life science businesses. And, you can also see on this next chart that those are companies that are trading. They're down in the bottom category here, and you can see that they're trading at the lowest levels of valuation relative to the index or to their own history over the last 10 and 30 years. And so, while that's been an area of quite a bit of activity in terms of new names, it's not a huge exposure yet, but it continues to be a place that we're finding opportunity. The other types of businesses that we've been buying across the last year really kind of span the pretty much the entire economy. So we've bought some leisure companies, we bought energy businesses, we bought building materials companies, we bought consumer staples, some commodity companies, telecommunications, and electrical businesses. And so, that's really where we think there is a pretty interesting opportunity today. And to the extent that this picture from the aggregate, the market picture remains the same, I think that'll continue to be where we focus our activities.
Brian, thanks very much. That was a number of great insights. We really appreciate that you took the time to be here with us today. Thank you.
Yeah, thanks for having me.
Great. And to everyone on the call who's joining us, thank you so much for sharing your time with us. On behalf of all of us here at Nedgroup Investments, we wish you well as we speed towards the end of the year. Thank you and goodbye.